Today, it's all about the world of crypto and blockchain. It can be confusing, definitely impactful, and we're using the book you sent us, Magic Money by Andrew Lunardi, as our guide.
Yeah, and it's a really interesting book because Lunardi mixes his own experiences in the crypto space, navigating it all, with some pretty sharp analysis.
Right.
He covers the tech, but also some of the, memorable moments. So our mission here is to sort of unpack the big takeaways for you, cut through the hype, help you grasp what's going on, the potential, but also the stranger side of things.
Exactly. And Lunardi definitely doesn't hold back on the wilder stuff, the shitcoin boom, the blockchain basics, some truly head-scratching stories. It's quite a journey he maps out.
It really is.
Now, we should say up front, the book has the usual disclaimers about the author's views, the risks involved. It's crypto, after all, so what we talk about reflects his take and the info he presents.
Good point. It's his perspective we're exploring.
Okay, let's get into it. And I think the place to start has to be that whole shitcoin era the book describes so vividly. It was something else.
Oh, yeah. That period during the COVID lockdowns, it was kind of a perfect storm, wasn't it? People had time, maybe some extra cash.
Right.
And it created this environment just ripe for speculation. The book really nails this core tension in crypto. You've got this amazing blockchain tech with real potential on one side. And then, bam, you get these super risky digital things popping up, driven almost entirely by hype.
Totally. And the examples Lunardi uses are great, like SafeMoon, join us on our journey safely to the moon. Catchy, right?
Yeah, very catchy.
But as the book points out, despite the name, the value basically went to zero after peaking. It just shows how powerful marketing can be, even if the actual substance is maybe shaky.
And what's wild is how fast these things multiplied. The book mentions SafeMoon as just an imitator, and even, get this, Moon Juice, a crypto-powered energy drink.
An energy drink, seriously?
Yep. It just shows the frenzy, People throwing money at almost anything with a buzzy name, just hoping it would rock it.
Yeah.
It really laid bare that split in crypto, amazing tech potential versus just like pure gambling on hype. Really highlights why you need to do your homework.
And you also had those pump and dump schemes. The book breaks down how organized they were, inner groups, outer groups, basically using inside info.
Right. Information asymmetry. It's an old trick, just, repackaged for the digital age.
Yeah.
And it really shows a big challenge in any new market, right? Early birds or insiders often profit from people who are just coming in who don't have all the facts. That structure they had, it's a big warning sign about just following hype online.
But it wasn't all just scams, was it? I mean, the book talks about meme coins too. Dog with hat, bonk. It started as jokes, literally internet memes. But they hit billion-dollar market caps, and the arbitrage stuff, making money just by trading them quickly between exchanges. It sounds kind of nuts.
Well, it raises that question, doesn't it? What is value? How much is just sentiment? These things start as jokes, but if a strong community gets behind them, if the market gets excited, they can have real value, even if it doesn't last. Look at that Bonk token story with the Solana Saga phone. The phone was basically a flop, right?
Yeah, I remember that.
Then boom, they airdrop Bonk tokens to phone owners, and suddenly, everyone wants the phone. Value just exploded out of nowhere. Pure market weirdness. It just shows how unpredictable crypto can be. Utility, demand, it can pop up in the strangest ways.
Okay, so underneath all this crazy speculation, there's the actual technology, blockchain. The book really drills down on this. For anyone still kind of wrapping their head around it, why is it so fundamental?
Sure. So think of blockchain like a digital record book, but it's shared, everyone involved has a copy, it's transparent, and it's really, really hard to tamper with, like virtually impossible once something's recorded.
Okay, unlike a bank's private records.
Yes, exactly. With banks, their records are private, centralized. On a public blockchain like Bitcoin's, every transaction is out there for anyone to see. That transparency is huge for security and trust because it's spread out, distributed, no single person can easily change it.
Right.
And the book also points out, people use crypto, token, coin, kind of interchangeably. They all just mean these digital assets living on the blockchain.
And this whole boom and bust cycle, it's not new for crypto, is it? The book mentions the 2017 surge too.
Oh yeah, 2017 was massive. Bitcoin went from around $1,000 to almost 20,000?
Wow.
And loads of other coins like XRP had even crazier percentage gains. The lure was just making money, fast. Similar vibes to the later shitcoin thing, but maybe across a slightly broader range of cryptos back then.
It's interesting how these waves connect. The book makes a link between the meme shares thing, like GameStop.
Right, Wall Street bets.
Yeah, and the communities driving these shitcoin rallies.
Definitely a connection there. The GameStop saga, with Reddit communities like Wall Street Bets coordinating buys, it really showed the power of online groups and social media moving markets. You had figures like Roaring Kitty becoming huge influencers.
Yeah, I remember him.
Then Satoshi Street Bets popped up as the crypto version, a Reddit group specifically for, those high-risk YOLO-type crypto bets.
YOLO, you only live once investments, basically throwing caution to the wind.
Pretty much. High risk, hoping for high reward.
And SafeMoon was huge on there, wasn't it? The book quotes this Reddit post, full of hype, definitely not financial advice.
Oh yeah, always the disclaimer.
Searching for a SafeMoon squeeze, just like the GameStop and AMC squeezes.
Yeah.
It really feels like history repeating itself, just with different digital things.
What's really striking is that sense of community, that shared mission you see in these groups. Sometimes it's framed as like sticking it to the man, democratizing finance.
Taking power back.
Exactly. So maybe it's not always just about profit. There's often this underlying ideology too.
But that strong belief, it can be taken advantage of, sadly. The book brings up CoffeeZilla's investigation into SafeMoon. Serious allegations about the founder moving crypto to personal wallets.
Yeah, that was a big expose. It's a rough reminder that transparency promises don't always equal ethical action, especially when there's not much regulation.
And the irony of the CEO winning some award while investors were losing big, it just highlights that gap between the hype, the PR, and what might actually be going on behind the scenes.
Absolutely. And SafeMoon trying to rebrand later as a serious tech company after being known as a shitcoin, it shows how hard it is to shake that initial image.
Okay, let's switch gears a bit. Another huge topic in the book, NFTs. Non-fungible tokens. Can you break down what they are based on the book's explanation?
Sure. So NFTs are basically unique digital ownership certificates. They live on the blockchain. The book explains it well by contrasting fungible things like dollar bills, where one is the same as another, with non-fungible things.
Like a house or a painting. Unique.
Exactly. Each one is distinct. Before NFTs, most crypto was fungible. One Bitcoin is like any other Bitcoin. NFTs brought this idea of digital scarcity and unique ownership into the crypto world.
And technically, the book says they're not super complicated, just a token on the blockchain with a unique ID and some extra info, metadata, pointing to a digital file, like an image.
Yeah, fundamentally that's it. The real significance of putting it on the blockchain is proof.
Proof of ownership?
Right, proof of ownership and authenticity. Because the blockchain record is public and can't be easily changed, you can definitively show who owns the original digital piece, even if people make copies of the image itself. The book uses that quantum artwork as an example. Lots of copies floating around, but only one NFT proving original ownership.
Then we get to CryptoPunks. The book credits Larva Labs guys, Matt Hall and John Watkinson. Their idea was pretty simple initially, right? Like digital collecting, kind of like baseball cards.
Totally. They were inspired by physical collectibles. They even gave most away for free initially, just keeping 1,000 for themselves. And interest was slow at first.
Really?
Yeah. It apparently took a Mashable article mentioning them for all 9,000 free ones to get claimed or minted. That article kind of kicked things off, sparked a bigger conversation about NFT value, especially among digital artists. The founders saying they accidentally became artists because of how the market reacted.
Yeah.
That's pretty funny.
And these punks, they have different traits, right?
Yeah.
Generated by an algorithm, which made some rarer and way more valuable.
Exactly. It's called generative art. The algorithm creates unique combinations, and some visual traits just appeared less often. So punks with rare traits commanded huge premiums.
And the book mentions that funny conspiracy theory about the face masks on some punks predicting the pandemic.
Yeah, the book debunks that one. The creators just said they were inspired by pictures of punks in Japan wearing masks. Less exciting, but probably true.
The price history is just wild. From maybe $50 early on to like $500,000 at the peak in 2021.
Insane numbers. The founders themselves were apparently blown away by the decentralized market that just sprung up around their creation.
Yeah.
It really shows how things get blue chip status in NFTs. owning a punk became a massive status symbol in the crypto world. Like, I was here early, I get it, I have money. And then celebrities jumped in, Snoop Dogg, Jay-Z, that just poured fuel on the fire.
And the total sales volume, over $3 billion, the book says, for digital collectibles. It taps into that basic human thing, right? Collecting rare stuff, status, just in a new digital wrapper.
Absolutely.
But interestingly, the original creators sold the IP, the rights, to Yuga Labs, the Bored Ape people. Why'd they do that?
Well, the book suggests Hall and Watkinson were more devs and artists at heart, into the tech, the creation.
Not the community management side.
Exactly. Running a massive brand like that, managing the community, the hype, it wasn't really their thing. Yuga Labs had shown they were good at that with Bored Apes, so it kind of made sense for the punk's future. And that whole PFP profile picture NFT boom in 2021, 2022, it was driven by lots of things, money floating around, excitement about what else blockchain could do besides just coins.
The author's anecdote about almost buying punks early but getting stuck on legal stuff, ouch, that's a missed boat.
Oh man, yeah, hindsight, right?
And then you get stuff like Ether rocks, literally JPEGs of rocks selling for crazy money. What was that about? Money laundering, historical value?
Pure madness.
It's one of those head scratchers. The book explores those angles. Is it laundering? Maybe. Is it because they were super early NFTs, so they have historical significance? Possibly. Or is it just pure speculation, scarcity, hype, people thinking someone else will pay more? The author leans towards that last one being a big factor.
And the weirdness continued. A ton of code collection pictures of, meant is social commentary, but still getting decent prices.
And Donald Trump's Trump cards NFTs selling out fast.
It just shows how experimental and, frankly, chaotic the early NFT market was. Right. People were tokenizing everything, testing the boundaries. Jack Dorsey's first tweet as an NFT didn't hold its value much.
Right.
But then Beeple's Everyday's selling for $69 million. The book pegs that as maybe the peak of the bubble. And then NFT airdrops became a thing too, just giving them away.
Speaking of airdrops, the book talks about crypto airdrops being potentially huge. That Blur marketplace example where traders got millions in free tokens.
Yeah, the Blur airdrop was massive, rewarded early users very, very generously. But the idea of giving away free crypto to get people interested isn't totally new. Remember Gavin Andresen's Bitcoin faucet?
Oh, right, way back, giving away free Bitcoin.
Yep. 5 Bitcoin per person, I think, just for solving a CAPTCHA. Imagine getting that now. It was crucial for getting Bitcoin out there initially. And early Bitcoin mining too, just running software in your computer to validate transactions that are in Bitcoin. That's how people like Hal Finney got started. He received the first ever Bitcoin transaction, 10 BTC.
It's hard to picture now. Mining is so industrial, so professionalized, as the book describes. Nothing like those early days.
Totally different ballgame now.
And then the horror stories, the lost fortunes, James Howells, the guy who threw out the hard drive.
Ugh, that story. It's brutal. Billions of dollars worth of Bitcoin just going in the trash. And his ongoing quest to dig up the landfill with robots and AI. It just shows the stakes, how easy it is to lose everything with one mistake.
And that other guy, Stefan Thomas, locked out because he lost his password.
Yeah, another nightmare scenario. It really hammers home how crucial managing your private keys is in crypto. You are your own bank, which means you're also your own security guard. Lose the keys, lose the money.
Okay, let's talk about Dogecoin. Started as a joke, right? Based on the Doge meme.
Literally. Jackson Palmer tweeted it as a joke, mocking all the new coins popping up. Billy Marcus then actually coded it, also kind of for fun.
Yeah.
It was never meant to be serious.
Never serious.
Not at all. Palmer's tweet was pure satire about investing in random coins.
But it got this really positive early community. Like the Doge tip bot on Reddit funding the Jamaican bobsled team. That's pretty cool for a joke coin.
It is. It shows how community can form around almost anything and do good things. But yeah, the book notes both founders, Palmer and Marcus, eventually walked away from it.
They just left.
Pretty much. But the story wasn't over, because then Elon Musk gets involved.
The Doge father.
Right. His tweets, his mentions, they just send the Dogecoin price flying. It's kind of crazy how much influence one person can have. He even changed the Twitter logo to the Doge for a bit.
I remember that. Caused a huge spike.
Exactly. It shows the power of celebrity and social media in these markets. The book links Doge's rise to that whole meme stock rally too. It all got swept up together.
And that story about the guy, Glauber Contesoto, the Dogecoin millionaire who didn't sell, that captures the emotional roller coaster of meme investing perfectly.
Oh, definitely. Holding on for dear life, hoping it goes higher.
Yeah.
It's intense. The book also makes a good point about blockchain transparency here.
How so?
Well, all the transactions are public on the blockchain. You can see the money moving.
Yeah.
But the users are usually pseudonymous, just wallet addresses, not names. So it's transparent, but still offers some privacy. Not total anonymity, though. People can sometimes link wallets to real identities if they dig deep enough.
Okay, let's go right back to the beginning. Bitcoin itself. Satoshi Nakamoto. The book covers the origin story, bitcoin.org registered, the white paper published. The goal was pretty radical, wasn't it? Peer-to-peer electronic cash, cutting out banks entirely.
Exactly. Direct transactions, person to person, online, no middleman. And the book highlights a key idea. Bitcoin's structure, with its limited supply, was designed partly to avoid the kind of currency debasement you can get with government-controlled fiat currencies.
Right, they could just print more money.
Bitcoin aimed to be different. That first transaction, just Satoshi sending to Hal Finney, no bank involved, that was revolutionary.
And the timing, right after the 2008 financial crisis? The book emphasizes that connection. Bitcoin as a response to the failures of the traditional system.
Very much so. The idea of decentralization, reducing the risk of one part failing, and taking down the whole system financial contagion was central. And that famous message embedded in the very first Bitcoin block.
What about the bank bailouts?
Yeah. The Times 03 Jan 2009 Chancellor on brink of second bailout for banks. It's like a permanent timestamp, a mission statement almost, baked right into Bitcoin's foundation, and alternatives to that system. And even early guys like Hal Finney saw the potential for it to be worth a lot someday. Satoshi agreed.
Which brings us to the big mystery. Who is Satoshi Nakamoto? Still unknown, right? The book dives into the speculation.
Totally unknown. Their last message was years ago. They're estimated to hold a huge amount of Bitcoin, like 1 million coins maybe. The name's a pseudonym. They use British English. It's all very mysterious.
And creating Bitcoin required expertise in so many fields. Math, cryptography, coding, economics, even game theory.
Yeah, it wasn't a simple thing. Suggests a very smart person, or maybe even a group. The book runs through the usual suspects people speculate about. Dorian Nakamoto, that Newsweek story that fell apart. Hal Finney himself, though he denied it. Nick Szabo, Craig Wright.
Craig Wright, the guy who claims he is Satoshi and sues people.
That's the one. Lots of legal battles. The book even mentions linguistic analysis, trying to match writing styles, like they did with J.K. Rowling writing under a pseudonym. But still, no definitive answer. It remains maybe the biggest mystery in tech.
Okay, shifting to another major event. The Terra Luna collapse. The book sets it up by talking about stablecoins meant to be the safe haven in crypto, pegged to something like the dollar.
Right, but then it highlights the sort of philosophical tension. If your stablecoin is backed by actual dollars in a bank, how decentralized is that, really? It kind of goes against the crypto ethos for some people.
So algorithmic stablecoins were the answer, or an answer.
They were proposed as an alternative. The idea was to use algorithms and smart contracts to keep the coin pegged to the dollar without needing actual dollar reserves. Terra Luna, with its UST stablecoin and Luna token, was a huge project aiming for this. UST was meant to power this whole decentralized economy.
And the mechanism involved Luna somehow.
Yeah, there was this complex algorithmic link between UST and Luna. If UST went below $1, you could theoretically profit by burning Luna to mint UST, and vice versa if it went above. It was supposed to automatically balance supply and demand to keep the peg.
Supposed to. The book mentions the Chai Payments app partnership, but also the SEC later alleging they faked some of the blockchain usage there.
Yeah, allegations of deception came out later. And then there was the Anchor protocol. This was key. It offered like 19-20% interest on UST deposits.
19%. That sounds too good to be true.
Exactly. The book points this out. It attracted massive amounts of money into UST, but also raised huge red flags. Accusations of it being unsustainable, basically a Ponzi scheme, were flying around. The author even mentions nearly investing themselves but getting spooked.
I don't blame them.
Those kinds of returns are just not sustainable normally.
Yeah.
So the Luna Foundation Guard was set up to try and defend the peg with Bitcoin reserves if needed, but it wasn't enough.
What happened?
Well, confidence started shaking, big players started withdrawing huge amounts of UST, and the algorithm just couldn't handle the pressure. UST lost its peg, fell way below $1, and then Luna went into hyperinflation, the death spiral, as the algorithm desperately tried to mint more Luna to prop up UST. It just collapsed.
And investors lost everything.
Catastrophic losses, billions wiped out. And tragically, the book notes there were reports of suicides linked to the crash. It was devastating for a lot of people.
And DeCall, the founder, he became a fugitive.
Yeah, on the run for months.
Yeah.
Eventually arrested in Montenegro. Now there are extradition battles, huge legal fallout. It was a really stark warning about the risks of these complex, maybe flawed algorithmic designs.
So the focus shifted back to safer stablecoins.
Pretty much. The book notes the trend moved back towards fiat-backed ones, where there are hopefully real dollars in bank accounts somewhere. And more talk about central bank digital currencies, CBDCs too. The appetite for purely algorithmic stablecoins definitely took a massive hit after Terra Luna.
And finally, the book covers the rise and dramatic fall of Sam Bankman-Fried, SBF, and FTX. He had this incredible ascent, right? Compared to JP Morgan even.
Yeah, the narrative early on was amazing. FTX grew incredibly fast. SBF was seen as this quirky, maybe more ethical crypto billionaire. But the book points out the contrast between his public image, downplaying wealth, sleeping on a beanbag, and the actual lavish spending behind the scenes.
And his other company, Alameda, they had early success with arbitrage.
Right, Alameda Research made a killing early on trading Bitcoin between the US and Japan, where prices were different. That built his reputation as a whiz trader. FTX launched later and just hit the market at the perfect time during a huge crypto bull run. Got big investments early on, even from Binance initially and Sequoia Capital.
Sequoia. Wasn't that the meeting where he was supposedly playing League of Legends?
Yeah, that's the story the book recounts. Playing a video game during a huge investment pitch. It's become legendary. Shows a certain something.
But things went sour with Binance and CZ, their founder. SBF was lobbying in DC.
Yeah, the relationship deteriorated badly. The book suggests SBF's lobbying was seen by CZ and others as trying to get regulations that favored FTX and hurt competitors like Binance, maybe playing on anti-Chinese sentiment. It got ugly.
And the Terra Luna collapse hit them too?
It impacted the value of FTT, FTX's own exchange token, which Alameda held a lot of. It put pressure on Alameda's finances. Remember, Caroline Ellison was CEO of Alameda, and the two firms, FTX and Alameda, were incredibly closely linked, maybe too closely.
So what triggered the final collapse?
It happened fast. A report came out questioning Alameda's finances, revealing how much FTT they held. Then CZ publicly announced Binance was selling all its FTT holdings due to recent revelations.
Uh-oh.
Yeah, that basically sparked a bank run on FTX. Everyone tried to withdraw their money at once. FTX couldn't handle it, halted withdrawals, chaos.
And Binance offered to buy them.
Briefly, CZ tweeted they had a non-binding agreement to acquire FTX to protect users, but then, like a day later, they pulled out. Said after looking at FTX's books, the problems were too big.
Wow. Just pulled the plug.
Yep. Then FTX declared bankruptcy. Sequoia wrote off their entire investment to zero. The new CEO handling the bankruptcy, John J. Ray III, who handled Enron, gave this absolutely scathing assessment, quoted in the book, saying he'd never seen such a complete failure of corporate controls. Just a total mess.
And the allegations were that Alameda was basically gambling with FTX customer money.
That was the core of it. And insider trading claims, too. SBF's trial, as the book summarizes, involved him basically claiming ignorance, saying he didn't know the details. But key testimony and messages like that "fuck regulators" one didn't help his case.
And CZ came out on top.
Pretty much. He was seen as the winner in that feud, though the whole episode damaged trust in crypto overall. CZ's assessment was blunt. SBF was a fraudster, a manipulator. It's a really cautionary tale about centralization, lack of oversight, and just, well, hubris in the crypto world.
Okay, let's quickly touch on DeFi and the airdrop revolution mentioned in the book. Uniswap was a big player here.
It's huge. Uniswap really pioneered decentralized finance, or DeFi. They created this automated market maker system, AMM. Instead of matching buyers and sellers directly like a traditional exchange.
Like an order book?
Right. Instead, you trade against these pools of tokens provided by other users, the liquidity providers. It was revolutionary. Though also risky, the book mentions rug pulls, where scammers create a pool, attract money, then vanish with it.
Nasty.
Yeah. But Uniswap grew incredibly fast. And then they decided to launch their own token, UNI, for governance. And how did they distribute it?
The airdrop.
Exactly. They airdropped UNI tokens to everyone who had used Uniswap for a certain date. And it was worth a lot. Thousands of dollars for many users just for having used the platform.
Wow, free money.
Pretty much. Yeah. And that kicked off a huge trend. Loads of other projects started doing airdrops to get tokens out there, reward early users, build a community. But it also created airdrop farmers.
People trying to game the system.
Yep. Creating tons of fake wallets, interacting minimally, just to qualify for as many airdrops as possible. It's called a Sybil attack.
So how do projects fight that?
The book explains they're getting smarter, using point systems based on how much you actually use the platform, how much money you provide, trying to filter out the Sybils and reward genuine users.
And airdrops are used competitively too, vampire attacks.
Yeah, that's the term. A new project might airdrop its tokens specifically to users of an established competitor, trying to lure them over. The book mentions Tensor targeting Magic Eden users on Solana, or new wallets targeting MetaMask users. It's all about grabbing market share.
It's a constant battle then.
Definitely. Finding fair ways to distribute tokens while stopping the gamers. It's ongoing.
So after walking through all this, the craziness, the scams, the collapses, the book ends on a more positive note, doesn't it? It acknowledges the absurd and crazy, but still sees tremendous positive potential.
It does. Despite all the drama, it circles back to the core technology and its possibilities. It mentions the good stuff. The Dogecoin community's charity, DAOs enabling new kinds of organization, gamers getting real ownership of assets, digital artists finding new ways to make a living. The author shares their own path to understanding blockchain, getting involved in Web3 gaming. The argument is, look, it's not just a scam. Underneath all the noise, it's a technology. And like any technology, it can be used for good or bad. The book even adds a helpful glossary at the end for terms like DAO, DAX, Degen, NFT, Shitcoin, smart contract audit, stablecoin, all that crypto jargon.
Okay, so wrapping this up, this deep dive into magic money has been, well, a wild ride, mirroring the crypto world itself. We've seen the incredible highs, the brutal lows, the genuinely cool tech, and the very human messiness of it all.
Greed, hype, innovation, it's all in there.
Exactly. It's volatile, it's complex, but the book argues it has real transformative potential. We covered lost billions, joke coins hitting billions, multi-million-dollar JPEGs, massive company implosions. Hopefully, weaving through all that gives you a solid grasp of this space without feeling totally lost.
And maybe the key thing to take away, as the book suggests, is that tension between the innovation and the risk. Decentralization opens amazing doors, but also doors for speculation, scams, chaos.
Finding the balance.
Yeah. As the tech matures, the challenge is nurturing the good stuff while managing the risks. Hopefully you feel better equipped now to follow what's happening, maybe explore more yourself, but with a critical eye.
Thanks again for sharing Andrew Lunardi's Magic Money for this deep dive. It was definitely an eye-opener.